all the 4 mini marathons of module A, B, C, D. Today we are with case study and PYQ sessions. We'll be doing this in 2 parts. One is part 1 today and part 2 tomorrow. Okay? I'll be covering important objective questions and some numericals in this, both today and tomorrow. So don't miss this, as you have not missed the earlier one also. I've seen all of you, the response was huge for all the 4 case mini marathons. Okay? So don't miss this, share it with your friends, share it on all your social media platforms, like this video. Sure, firstly like the video, because what happens, we all follow it everything, but we forget to like it. And also share it with your friends. Each one should share it with at least 5 students. Sharing is caring, isn't it? So, everyone, just share it and let's start. Which of the following off-balance sheet exposure items come under the low risk categories? Here, understand the question properly. Which of the following off-balance sheet items? Okay. So, already it's given, these are off-balance sheet items. Already it's given. Now, out of that, we have to check which of these off-balance sheet items are low risk and medium risk. I mean, basically low risk. Question over here is of low risk, but I'll give you the idea about medium risk also. Okay. So, which of the following are under low risk? Swaps, LC, money guarantee, and indemnities. Let me see. Because what happens, many of us think, we feel that swap, big name, because we don't know. Many of the bankers retail, we are in retail banking. We don't know what is swap. We feel very difficult. So that's why, which is this low risk? No. This will be of high risk. LC, I know something. I've heard about it. So LC, yeah, it is in low risk. Money guarantee, okay, low risk. Secondary payment. Then what? Indemnity, I give it in FD. It is low risk. So which is the correct answer then? So look at this. The correct answer is swaps. Totally reverse. What you are thinking is totally reverse of that. Swaps are the lowest risk. Okay? Why? Why lowest risk? What is a swap? Swap is always the exchange between 2 cash flows, streams of 2 cash flows. Okay? Basically, in your numericals, I'll tell you, swap means what? It's the exchange between the spot rate and the forward rate. See, the swap means it's the exchange between spot. What is the present thing? Spot rate and forward rate. It is the exchange between these. Okay? In swap, always remember, one leg is fixed. So, in this, which leg will be fixed? Fixed means which I know. Which I know. Right now, I know this on the paper. I can see this. So, that is spot. Spot is fixed. Because this rate is known to you. And what about the forward? Forward is unknown. You are guessing. You are guessing the rates. So, this is unknown. So, this is floating. Okay? Got it? So, spot and forward. Got it? So, fixed and floating. So, that's why spot is the lowest. You will say, sir, you are only giving half knowledge. Spot is, this is low risk, then what is the high risk? Isn't it? Natural question will, so we'll categorize it. High, medium, and low. Let's do it. Okay? Where you have the full responsibility on yourself, complete responsibility. Where do you have complete responsibility? All these 3. Complete responsibility. Understand, here I am talking of LC issued by the bank, bank guarantee issued by the bank, indemnity given by the bank. I am not talking from the customer side. Here I have given all these things as a bank. So this becomes a primary mode of payment then. LC, these are all, you have to pay compulsory. So this is the high risk. Which is a medium risk then? Medium risk means where someone else is involved. 50% risk is on that person, 50% on me. Medium. Which is that? Performance guarantee. Performance. In performance guarantee, what happens? Whenever bank issues a performance guarantee. Okay, here I am talking of money guarantees. Okay, understand the difference now. Money guarantee, there is also something called as standby guarantee, general standby guarantees, financial guarantee. These are all under high risk. And whenever I am talking of performance guarantee, means someone else is performing. In that case, it becomes medium risk. Why? Because if he doesn't perform, somebody is building a road, I give a guarantee on his behalf to that government body. So if he does not build the road, then only I'll have to pay. So there is someone who is doing something, right, related to performance. And low risk means all these, where you are just juggling with this money. Very low margins are there. That's why what happens, these are of low risk. All these swaps, forwards, FRAs, these are all low risk. Okay, got it? So these are the three categories. Got it, everyone? Clear? Type yes in the comment section. Is it clear, everyone? Yeah? Chalo, next. Use forward rate agreements. Okay, topic for today is this, derivatives. You have seen the topic now? This derivatives now. So we are in this. Use forward rate agreements, swaps, options, financial futures to construct synthetic securities and does hedge against any exposure to the interest rate risk. Means, what is this FRA? Use forward rate agreements, swaps, options and financial futures. First part of the question is over here, up to this. What are we talking of over here? Here we are talking of 4 different derivative products. FRA, swaps, options and financial securities. So these are 4 different derivative products. Okay. These are known as simple derivatives. Simple means what? All these, if you see, these are simple derivatives. Means what? There are only 2 legs. One is this, one is that. Fixed leg, floating leg. Spot, future. Like this. So these are simple ones. But what is the question? The question is, we are using this combination. Means I am combining forward rate with swap, or futures with FRA, or futures with swap, something like this, combination. So use the combination to construct a synthetic securities and does hedge against any exposure to the interest rate risk, exposure to interest rate risks. So which one? All of them? See this, 1, 2, 3 and 4. Let's call this A, B, C, D. Okay, all of them. So do we use FRAs for constructing the synthetic securities? What is synthetic security? See, the synthetic security means it's a combination. Kindly note this, synthetic. Synthetic means it's prepared. Synthetic security. So it is equal to FRA plus, let's say, swap. So combination of these, FRA plus swap, or anything it can be, FRA plus forward, or swap plus something else out of these 4 options. Okay, so you can use it, all of them. Okay, all of them over here. So I think so 1, 2 and options and financial futures, these are combined over here. So the answer is all A, B and C. Got it? When the buyer has to pay the interest in rupees and principal in USD, the borrower may hedge the interest rate, only the interest rate, and it is known as, what is this? Now we come to something difficult. Okay, we are coming to something difficult. What is this difficult? Let's see. See this. Here we are talking of the buyer has to pay. Pay means what? Understand the term. Here we are talking of a Bharatiya firm, Indian firm, Indian company. This Indian company has taken money from some foreign company. Understand the problem correctly. It has taken the money from some foreign company, let's say USA. Now this USA guy has given the amount, okay, to this Indian company. Now look at the case. The Indian company has to pay the interest in rupees. So interest I have to pay in rupees, and principal I have to pay in dollars. Now which hedging will I use? Which this swap will I use? All this swap is basically for hedging. So which swap will I use? Will I use principal only, currency only, coupon only, or interest only swap? Which will I use? Now I'll tell you what the problem is. All of you will get confused over here. Many of you might have thought of that answer as this or this, A or D, principal only swap, because what you are thinking, array, principal I have to pay in dollars, I have rupees, so principal is the problem, dollar might go up down, so I'll be using that swap. Some of you might have thought that no, interest rate, name itself na, interest rate is to be paid, interest is to be paid in rupees, so interest only, simple, isn't it? Both are wrong. Both are wrong. Okay, what is the answer then? Both are wrong over here. See here this person has to pay compulsory interest. Compulsory interest means what? It's called as coupon. When you're in any bond, there are 5 terms. Which are the 5 terms? Tell me. Which are the 5 terms in any bond? Number 1, face value. Right? Second one, coupon, and third one is tenure, right? Period of that bond, remaining period. Next, market rate and market price of that bond. So these are the 5 terms. Out of these 2 change, always change, and these 3 never change. They are always fixed. Change. But understand this. Coupon is also interest only. Coupon is also interest. And this market rate is also interest. Both are interest. Okay, but this is compulsory, not changing, and this is changing. Okay. So these you might be knowing all these things. Okay, because you have already done this. So it was just a revision for you. So now the point over here is, what is this? So now the point over here is, which one? So the point over here is, what is the answer then? Okay, let this remain as it is. So now what is the answer? The answer over here is coupon only, sir. Coupon only. Why coupon only? Because this person has to pay in dollars principal. Now this USA guy will accept it in dollars. He had given money in dollars. You are paying in dollars. So dollar adjusted, no change. But here in interest you have to pay in rupees. Now this is a problem. There you might face the problem in this forex. If I am getting the money in dollars, using it in dollars and giving it back in dollars, no issues. But if I am getting it in dollars and paying it in rupees, then there is the issue. So I'll have to use this swap of coupon only, not anyone else. Got it? Which of the following is a potential cost of adverse movement of interest rates that a bank faces on its deposits, borrowings, lendings, or interest rate derivatives? So which of the following is a potential cost of adverse rate movement? Cost of adverse rate movement of interest rates. So interest rate is going up or down. Okay. So where will I face the major NII difference or spread difference? Where will I face the income difference? Think: legal risk, operational risk, interest rate risk, country risk that a bank faces on its deposits, borrowings, lendings, or interest rate derivatives. What is the answer? All of you have thought of one answer, I know. All of you are thinking that interest rate risk. But then your second mind says, such a easy answer, how is it possible? Interest rate, such a, no, kuch to gadbad hai. There is some problem. Interest rate risk is not the answer. So what will you do? You know this answer is correct, but you will mark something else. Why? Because you are thinking, how can the question be so simple? But actually remember, almost 60% of your BFM questions are straightforward, simple. So the answer is interest rate risk only. That is the answer. See here, on your deposits, borrowing, lending, interest rate derivatives, everywhere you face the same interest rate risk. What is this interest rate risk? What do you mean by this? Chalo, type in the comment section, everyone. Let me see. What is the interest rate risk? Yes. Give me in one line. What is the interest rate risk? In one line. See here, interest rate risk means interest rate. Look at this. Very important. See here, these two risks are always related. Which is this? Interest rate risk, and second is price risk. Price. These two risks are always related to each other. Price risk and interest rate risk. Always related. Why? Because it's like this. What is the interest rate? Interest rate means any benchmark rate. Let's say repo. If RBI tomorrow increases the repo, then what will happen? You'll always face the problems now. In that case, what happens? Your deposit rates will go up, your loan rates will go up. Reverse case, if RBI tomorrow decreases the repo rate, your deposit rates will be down, loan rates will be down. So that is the interest rate problem. But also there is one more problem regarding this price risk. This price risk is related to the bond prices. Bond prices. You all know how big this bond market is. Debt market is the biggest market in the world. So bond prices are negatively affected by the prices. Means what? If the interest rate goes up, the price of the bond will go down. Always. And reverse is also true. If the interest rate goes down, the price of the bond will go up. Okay? That's why you see in the present situation, some of the countries are facing huge inflations. Even US was facing the same inflation. Okay, UK, England, Germany. Okay, these all countries are facing inflation now. Because of that COVID, during the COVID, they distributed the money. Okay, so that's why they are facing the problems now. So now, the point over here is, because of this, the central bank has to increase the interest rates. Here, whenever the inflation is high, kindly note this. I'll give you a simple logic now. You should be very clear in your BFM in this part. Okay. So I'll give you a simple logic. If the inflation increases here, if inflation goes up in any country, inflation goes up. Okay. What will happen? The first thing your central bank or RBI will do is increase the interest rates. They will increase this interest rates. This is the cause and this is the solution. So this is the solution. So RBI will increase the interest rates. But if they increase the interest rate, what happens? Your bond prices fall down. So bond prices fall down means what? Those who have purchased the bonds earlier, their prices are down, so they are in losses. So immediately the bond prices go down and people face losses. This is a linkage always. Kindly remember this. Okay. Inflation up, RBI will immediately, RBI or any bank, not only RBI, any central bank in the world, it will immediately increase this repo rate. Repo or whichever benchmark they are following. They will increase the benchmark rates. Okay. Next. So you got the answer. The answer was interest rate risk. Clear everyone? Move on. Type yes in the comment section. Which one of the following is not a type of foreign exchange derivative? Very tricky. Very tricky. Not. Let me see. Foreign exchange forwards, currency exchange future rate, cross currency option, foreign currency rupee swap, Now let me get the answer from you now. Let me see. Let me get the answer from you. What is the answer for this? Not, you want not, which is not a derivative. Forex derivative. Very tricky one. Let me see in the comment section, what are you answering? Yeah. Think, everyone think. Very simple answer, very simple. Yes, it is very simple answer. So, the answer is this. Currency exchange future rate. Okay, let me explain you. See this. Foreign exchange forward. Forward is a type of derivative. Kindly note. These are all the names of the derivatives. Forward, option, swap. These are all the names of the derivatives. Even future is a derivative. This is also a derivative. Then you will say, sir, if this is derivative, then how are you saying that it is not a forex derivative? Because the real word over here and real catch over here is this. This is the real catch, which all of us are missing. We are reading these three words, but we are not reading this word. This is not a derivative. This is simply a rate. This is my forward rate. This is my future rate. $1 today is, let's say, $85. $1 after, let's say, 4 months or 3 months is $88. 88 rupees. Okay. So this is simply a rate. How can it be a derivative? Derivative means what? Kindly note, in any derivative, there are two things. Okay. One is risk involved. Risk involved. What is the risk involved over here? I am telling you. After 2 months, the rate of this flat will be, whichever flat is, will be, today it is, let's say, 1 crore. After 2 months, the rate will be 1.25 crores. What is the risk? No risk. It's the rate. You want to buy it, you buy it. You don't want to buy it, you don't buy it. Isn't it? So, future rate, this is simply a rate given. And kindly note, in any derivative, there is always a risk involved. Some risk should be there. It's always a juggling. Any derivative is always a juggling between present and the future. Always. There are always two legs in any derivative. Like in swap we have, similarly in forward also we have. Similarly in future we have. Similarly in options we have two legs. So everywhere you have these two legs. One is fixed, second is floating, or we don't know. Okay? But this rate is nothing. Rate is simply a rate. Movie ticket rate. What is the derivative in this? Nothing. Okay? Derivative contracts that are traded directly between two eligible parties are called. Now, which derivative contracts are traded directly between the two parties? Over-the-counter derivatives, exchange-traded derivatives, direct derivatives, and spot rate derivatives. Think. Which of the derivatives are traded actively between the two parties? Which derivatives? Actively traded between only two parties. Then I will give you the explanation also. Over the counter, exchange traded, direct derivatives and spot derivatives. Answer is comments. Let me see in the comments. It is over the counter. Kindly note, OTC, there are two types of derivatives. One is ETC, exchange traded derivatives, and OTC, over the counter derivatives. Okay, what do you mean by this? See this. In OTC derivatives, there are only two parties. Like, I'll give you a simple example. When you give a loan to any customer, which are the parties in that loan? You and the customer. So, there are only two parties. So, two parties over here. Two parties. Buyer and the seller. Buyer and seller. Okay. Now, next part. Suppose if in ETC, exchange traded derivatives, in exchange traded derivatives, there are three parties. I'll give you one more example. When you buy the shares in the stock market, you buy any share, let's say Reliance you buy, or any Infosys you buy. Do you know the seller? So who are the two parties now? You buy, buyer, and there is seller. But do you know the buyer and the seller? Do you know the buyer and seller? Do you know who has sold it? That's why you have bought it. You don't know. Why? Because there is a third party in between, that's called as exchange. Exchange, NSC we call it, NSC, right? NSC or BSC, anything. So there is a third party involved in this. So kindly note, third party involved over here will set the rules. Exchange set the rules, sets the rules, set rules. It doesn't let the buyer and the seller meet each other. It creates a pool of stocks and funds. So, this exchange always covers the credit risk. Credit risk is very important. Credit risk means what? What do you mean by credit risk? Here, over here, in OTC, there is always a credit risk involved. So here, credit risk is covered. Okay? But in there, OTC, credit risk is always there. Why? Because, what do you mean by this credit risk? Here, I am buying the contract, I am buying the dollar, or I am buying anything. Let it be any commodity. I am buying it. So I'll give you money. Now the problem is, if you don't sell me that commodity, then so this is the main problem. Or reverse case is also true. I am selling and you are buying. So I give you the commodity and you don't pay me. Then both the cases are, so this is known as credit risk. Whenever the other party doesn't perform, it's called as credit risk. Okay, issuer problem. But this problem is taken care of in your this ETC, because exchange fixes both of them. It acts like a broker. Okay, so it will always fix both of them. Got it? So that's why ETC exchange traded this derivatives, okay, or OTC are between two parties and ETC are between three parties. Okay. Next, which of the following statements regarding over-the-counter derivatives is incorrect? Now look at this. I have just now explained you OTC. Now give me the answer. Which of them is incorrect? It is the decentralized trading market used by small companies. So decentralized trading market. OTC is obviously decentralized. Why? Because there are only two parties. Various banks. Let's say Bank A, Bank B, Bank C. Three banks are there. Each bank will deal with separate customers. Customer X, Y, Z. So they will set their own rules. X, Y, Z, they'll set their own rules. It's a decentralized market. Okay? Decentralized trading market used by the small companies. Generally, it's used by the small companies. True. But what do you want? Incorrect. Your answer should be incorrect. This is correct. What is the second one? Trading takes place during fixed exchange hours. Fixed. Is there a fixed exchange hour in OTC between your bank and the customer? Does your deal take place only in between typical time? Banking hours only. You go to meet that customer later also. Then you decide. You speak to that customer. So there is nothing like this. So this is incorrect. And this is what you want. Trading does not take place. Trading takes place during the fixed exchange hours. That is wrong. Trading does not take place during the fixed exchange hours. In future market, see this, in forward it is between two banks only, two parties only. Me and that other party. So that other party, we may decide on the trade, on the meeting, or we may decide on the timing. Suppose if some customer is having, I am going to meet a Reliance client, Reliance, big client, or I am going to meet Infosys, and I'll say, I will come during 12:30 to 3:30. My timing of bank is between 10:30 and 3:30. I'll meet you between that only. I won't meet you later. Infosys will say, out. Reliance will say out. They will say whenever we have time, then you meet. We are having time in the evening, come in the evening. So no fixed hours. Whereas in future contract, it is a fixed hour. NSE, BSE, buying the stocks, shares. Can you buy it after 3:30? No. Because there you have fixed hours. Here you don't have. Okay. So this is wrong. But let's see others also. OTC doesn't have a specific physical location. Instead, persons involved in the trading directly negotiate over the communication network such as telephone. Obviously, that's what we do in banking, isn't it? Whenever you speak to the customer, you speak it over the phone, your email, your whatever, 1,000 calls are there, WhatsApp calling. Okay? Bonds and currencies are traded in OTC. Is it so? Bonds and currencies. So this is right. But is this true? Bonds and currencies can be traded in OTC. What do you do in forward market? What is a forward? Forward, whenever you book a forward for the customer, what do you do actually? You are actually booking the rates of the currencies. So that this is also true. So only answer over here is false. Trading. Which of the following liabilities are not excluded from the CRR calculations? Understand the question. Which of the following liabilities are not excluded? It's not excluded. They are not asking which are excluded. They are asking which are not excluded. Not excluded. Okay, from the CRR calculations. Paid up capital, refinance from SIDBI, claims from DICGC and overseas borrowing. Not excluded. What is CRR basically? How is CRR calculated? CRR is calculated on the basis of NDTL. NDTL, net demand and term liabilities, right? Demand and term liabilities. So, these liabilities are related to mainly from the customer angle only. Liabilities from the customer or from the other institutions. Okay, customers which are a part of your banking business. Here, understand this. Which are a part of your banking business. Okay, other banks, loans, all these. So what do we include in this demand and term liabilities over here then? Paid up capital. Is it a part of demand and term liabilities? Let's see one by one. Paid up capital. Is it a part of demand and time liabilities? Term, yeah. Paid up capital is a part of capital part, tier 1 capital. This is the part of tier 1. This is not the part of your business. Paid up capital is not the part of your business. Okay? It's a part of your capital. So that's why this will never be included in your CRR calculations. Got it? Because in CRR, what do we include? What is my business? Regular business. My regular business is what? Taking the deposits, giving the loans. So that will be included. Here we are talking of deposits only because liabilities. Here I'll talk of this saving current CASA and term FDs. Plus, what are other liabilities? In the course of business, I may take the liabilities like this. Here, what are the main liabilities of any bank? Liabilities. What are the main liabilities of any bank? One, CASA. Second, FD or term deposit we call it. Third is borrowings. Bank will also borrow. Okay, bank will also borrow from various institutions. That will be the part of your this borrowings part because that's the liability. But that should be the part of your business. That's important. Okay. So coming back to this point, paid up capital, tier 1 capital. Similarly, reserves and surplus, here there are 2-3 parts. Net profit, reserves and surplus, R&S, revaluation reserves. Let me remove all these. See this net profit, reserves and surplus, R&S, revaluation reserves, reval reserves we call it. These are a part of your tier 1 capital. So these are not included in your CRR calculations. Similarly, refinance from SIDBI. Is this your business? Getting refinance from SIDBI is your business? No. Okay. So, which are not excluded, it's mentioned. Huh? So, they are included. Understand these wordings. Not excluded means included. Included. Okay. Which of the following are not excluded from the CRR calculations? So, this is not excluded. Then second, refinance from SIDBI. This is not your regular business. Okay. So, this will also be not excluded. So, it will be included. Okay. This will also be included in this. Then claims from DSCGC. This will also be included. Okay. Not excluded here means included. But overseas borrowing. Overseas borrowing. Okay. So, this will be not excluded from this. So, this is not excluded means this is included. Included. And these all are not included. These all are not included. Not included. Okay. Paid up capital is not included in CRR calculations. Refinance from SIDBI is not included in CRR calculations. Claims for DSCGC is not included in your CRR calculations. Why? Because these are not your regular course of business. That is not your business. To get a refinance from SIDBI or this claims from DSCGC, this is not your regular business. So that is not included. But what is included? This overseas borrowing. Because this is a regular course of business. This is what you do. You get the loans from somebody and give the loans over here. Means what do you mean by this overseas borrowings? Here we mean ECB, external commercial borrowing. ECB, kindly note. In ECB what do? The bank takes the loans or gets the funds from some other bank in US at a lower rate of interest. US or any country at a lower rate of interest. Okay. So this ECB is at roughly around 2.53%. They take the funds and then lend it over here to our companies at higher rate, 7.5. Corporate finance is at around 7%. So get a margin of around 4.5% roughly. Okay, so this is included because this is your business. Okay, got it? Everyone clear? NPA is a loan or an advance. Where? So what is an NPA? Interest or installment of the principal remain overdue for more than 45 days in respect of term loan. Interest or installment remain overdue for more than 45 days in respect of term loan. The account remains out of order in respect of an overdraft cash CC, means overdraft cash credit CC. The bill remains overdue for more than 45 days in case of bills purchased and discounted. The installment of the principal or interest thereon remains overdue for 2 crop seasons for long duration crops, long and 2 crop seasons. Now this is a simple one. Every one of you must get it. Show me in the comment section. Let me see in the comment section. Yes, very simple one. The answer is here. This answer is not correct. 45 days. The rule is 90 days. 90. Okay. Everywhere the rule is 90 days. Okay. The rule is 90 days. Everywhere. Then 45 days over here. Again 90 days. So that is also out. In long duration crops, the period is 1 crop season, not 2. So this is 1 long duration crop. It is 1 crop season. Now many of you might be asking, sir, how do we know we are bankers? Which is 1 crop, which is 2 crop, which is long, which is short? I don't know. In that case, what do we do? In that case, the list is given to you by the bank. It comes from RBI and various institutions. So you need not worry about it. Okay? Work as per the list. Don't apply your own brains. So the correct answer is over here, out of order in respect of overdraft CC. If any account remains out of order constantly, what is out of order? Out of order means, suppose if I have sanctioned a CC of let's say 1 lakh rupees, okay, and that account constantly moves, means that account is constantly above 1 lakh. So it is generally, the average balance is around 1 lakh 1000 constantly for all the 3 months. Then this is called as out of order. When any account is out of order constantly for 90 days, it is called as NP. Okay? It not only depends on the sanction amount, but also on the DP calculations. If it goes beyond your DP, then also it's called as out of order. Okay, got it? So the correct answer is this. And the correct answers for these are also, kindly note, 90 days. These are the correct answers. Now I told you we'll be solving some numericals. Very important ones. Because these will give you the idea. These will clarify your doubts in the minds, which are very useful in the exams also. Very, very useful. It will clarify the doubts regarding options, futures, derivatives. See this, first one. An investor enters into a short gold futures. Short, understand this word short. I have taken this many times. Short means short gold futures. Okay. When the future price is 60 cent per pound. 60 cent per pound. Now see this. This is mentioned as gold. You can take it as dollar also. Anything. Commodity is a commodity. It can be gold, it can be dollar, it can be stocks, it can be anything. So this commodity is not important. The transaction is important. Okay. So 60 cent per pound. One contract is delivery of 60,000 pounds. So one contract is of 60,000 pounds. How much the investor will gain or lose if the gold price at the end of the contract is 58.2 cents per pound and second 61.3 cents per pound. So two cases are given over here. In exam you will be getting these two cases separately. Of course, in exam they won't be giving you as gold, they will be giving you as dollar. But after all, it's one and the same thing. Okay. So 60 cent per pound future prices and one contract for delivery is this 60,000 pound. Means if you have to purchase one contract, you have to invest this much. Okay. And now the rate goes to 58.20. Then what happens in this case? Now I'll explain you. Sir, I want to ask the answer from you. I'll be explaining you the case today because I know many of us are not into this daily business of options and futures, right? We don't know that much. So that's why I'll be explaining you the case. Let's take the first case. In case of pound 58.2, means first case is of 58.2, second case is of 61.3. Okay. So in case of pound 58.2, investor is obligated to sell, say this, enters into a short gold futures. Okay, short gold. Now here, investor is obligated to sell 60 cents per pound, something that is worth 58.2 cents. Now what do you mean by this? Per pound. Okay, so there is a gain to the investor per pound. So there is a gain to the investor of 0.6 minus this much, 0.5820 and into 60,000. Means what? What is all these calculations? See, a rate is very simple. This 58.2 cents, when we call 58.2 cent, now see this, I'll call it rupees, okay, call it simple. This is, let's say, because cent is also a term used in your BFM. Let's say call this paise and let's say call this rupees. Okay, rupees. Wherever we have pound, call it rupees. Wherever we have cents, call it paise. So investor is obligated to sell 60 paise per rupees, right? Paise. per rupees. Okay, something that is worth 58.2 paise. So what does it mean? This 58.2 you'll have to divide it by 100 because we are talking of paise and rupees now. We are converting this paise to rupees. So we'll divide this by 100. So it is 0.58. So 0.58 I have taken over here. What is the present price? He has entered into what? See, a rates given initially. 60 cent per pound means 60 paise per rupees. Okay. So this now, what is the difference in this? 60.6. So 60 means 0.6. 0.6 minus 0.58 into 60,000 because total net amount invested is 60,000. So 0.6 minus 0.5820 into 60,000 equals to 1080 rupees. So there is a gain to the investor. Investor will gain in this. Investor will gain. So if I have entered into this contract, there will be a gain for me. Why? Because I have entered into the contract to short gold futures. Short. Okay. Means I have sold it first, then I will be buying. If the price goes down, here I have very simple logic I will give you. I have sold it at 60 and now the gold price is at 58.2. Right? Simple logic. I have sold it at 60. Now the gold price is at 58.2. So what will happen? I have sold at 60, 58.2. Difference is what? 1.8, right? Into this much amount, 60,000, whatever it is. So you just see this multiplication. 1080, 1.80. So you'll just multiply it. You'll get the same answer. Right? So it's simple calculation. What rate I have sold, what rate I am purchasing. Now second case is also a similar one. Now the price is 61.3. So I have sold at 60. I have shorted. Shorted means what here? It's given short. This short. What do you mean by this word short? Short means sell first. Here, understand this word short. Short means sell first. Sell first. And then buy later. That is short. Long means what? Long. Long means buy first. Buy first. Okay? Long means buy first. Sell means, short means sell first. So here, I have sold it at 60. So sold at, let's say what is the rate? 60. And buying at what? Now the price has increased. In second case, the price has increased 61.3. So subtract it 1.3, right? 1.3 into this 60. Do the calculation. Say this 1.3 into 60. Do the calculations. 78. Okay. This will be the answer. 780. We'll have to do this points this adjustments and the answer is 780. Isn't it? Simple logic is at what rate do I buy and what rate do I sell? Got it? So 0.6130 minus 0.6. If you subtract it, divide it by 100 because this is cents and this is pounds or this is paise and this is rupees. So divide it by 100 and multiply it with 60,000. So zeros will go and this remains, whatever remains is this 780. Okay? Got it everyone? Clear? Simple calculation is buy at what rate, sell at what rate. And that's the difference. Next one, second one. Suppose an investor writes a put. See this, writes a put. Now understand this word. Writes the put. What is writing of the put? Kindly understand one point. Whenever you buy the put, buy. There are two things. One is buying and second is selling. Selling. Whenever you are buying the put, buy the put. It means what are you doing? What are you doing? So whenever you buy the put, you gain when the market goes down. Whenever you buy the put, you gain. Your profit is when the market goes down. Market is or rate is down. Market down means rate is down. Whenever you sell the put, okay, sell the put. And then the market is down. Market down. Then you will lose. Loss. You will have a loss. Kindly note. Okay. So buyer of the put option will always have gains when the market goes down. Reverse is also true. Now, if I speak of this, discuss the same thing about call option. Call is similar one. In call, what happens? Call. So buyer will profit when the market is up. Okay. And here call, if I sell the call. Okay. The seller will profit here. Here we are talking of seller. Here we are talking of buyer. Seller will profit when the market is down. Kindly note this basic logic in call and put option. Seller of an option or seller of any derivative, okay, will profit when you have these scenarios. Mainly put and call. Seller of the put will benefit when the market is down. Buyer of the put, will benefit when the market is up. Buyer of the put will benefit when the market is down. Kindly keep this table handy for you. Handy. You must understand the basics of call and put. When will the buyer of the put benefit? When will be the seller of the put benefit? Now, seller means what? Writing the put means selling the put. Writing means selling. Understand this word. Whenever you get the word write the put, it means you are seller of that put. So, you are in this category. Okay. Suppose if I say, okay, now in the comment section, let me see. I am writing the call. So who am I? I am seller of the call or I am buyer of the call? You answer me. I am writing the call. So who am I? Am I seller of the call or buyer of the call? In the comment section, everyone. Am I seller of the call or am I buyer of the call? Comments. Let me see. I am seller of the call. Okay, seller. Okay. When will I benefit? I am writing the call. When will I benefit? See this table. When will I benefit? I'll benefit when the market is down or the rate goes down. Market down means rate down. Okay. So now let's look at the question. Suppose an investor writes a put. See here we are in this case. Writes the put. Here we are. Okay. So market is down. The investor will benefit. Profit. Okay. Loss. Market is down. The investor will make a loss. Right. In this case we are. And if market is up, the seller will always make the profit. Okay. This case we are. On a built company stock. Now, built company means what? It's the name of some company. You can take it Infosys also. Infosys company stock. Okay. With a strike price of 50. So, strike price of 50. So, this person is writing the put. Means selling the put. At the strike price of 50. Now, what does it mean? I'll explain you. Okay. But never forget this logic. Because everything depends on this logic. Okay, and expiration date is 3 months. The current price of the built stock is 51. So he has written at 50, he has sold it at 50. And now the price is 51. What do you committed to yourself? Means suppose if you are the seller, what have you committed to that? Means if I am the seller, okay, so I am this investor. What have I committed? What have I told the person in front? I am the seller means there is a buyer. So what have I told this buyer? How much could you gain or lose? So how much can I gain or lose in this case? Now strike price is 50 and this current market price is 51. I am the seller of this call. Or what? Put. Okay, seller of this put. So remember this table. Let's move to the explanations. Here this also I will explain you. I won't ask you the question over here, right? I'll explain you. See here, read this properly. You have sold the put option, sold. Okay, you have sold the put option. You have agreed to buy. See here, sold the put option means what? You have agreed to buy 100 built shares for 50 per share. So whenever you are selling, you mean that, what do you mean by that? That this share price will not go below 50. That means, it means that whenever I sell the put at 50, it means I am telling that further the person next to me that this share price will not go below 50. So it means what? I will be buying it at 50. At any cost, I will be buying it at 50. Because I believe this will never go at less than 50. अगर 50 से नीचे गया तो मैं लूंगा, चलो 50 के भाव पे मैं लूंगा. That's what I'm telling this person, whoever is a buyer. So I'm agreeing to buy the 100 build shares at 50. If the party on the other side charges to exercise, means if there is a buyer, let's say I sell this and there is a buyer. Now this buyer, when will this buyer gain? Understand this clear logic. When will this buyer gain? This table is very important. I am seller of the put. When will I gain? When the market is up. When the market is up, I'll gain. I'll make the profit. Okay, I will make the profit. If I will make the profit when the market is up, it means what? Here, it's a 2% theory. 2% gain theory we call it. It means if I make the profit, the other person will make the loss. Simple rule is this. So here what will happen? If this market price goes down, okay, goes down. So in that case, who will make the profit? Market price is going down, I will make the loss, so second person will make the profit. If the market price goes up, I will make the profit and this other person will make the loss. Okay, so that is the basic logic of put option. That's why I said this table is the most important table for you throughout your life. Those who are dealing in call and put options in your daily life also, very important table. Okay, so you have agreed to buy 100 build shares for 50 per share. If the party on the other side charged to exercise, means they work on it, they buy it. The option will only be exercised by the counterparty if the price of the build share is below 50. If the share price goes to, let's say, 30, see this, suppose the party exercises when the price is 30, means I said that the share price will not go below 50. I will buy at 50. And now what happens? The share price goes to 30. It has gone to 30. From 50 it has gone to 30. So what am I? I am the loser. See this. You have to buy it at 50 because I told you 50 के नीचे नहीं जाएगा. मैं लूंगा 50 पे. गया 30 पे गया, 30 पे गया. Now you buy at 50. You had told me ना, that buyer will say, you had told me ना, नहीं जाएगा, ये लो 50 पे buy करो. So I will have to buy this stock at 50 when the actual price is only 30. Okay, so the loss to the writer, see this, investor or writer will be 20 per share, isn't it? 20 is a loss, and whatever is this amount, whatever is the number of shares, is there given how many shares? No, no. If they give you some 2000 shares, say this example is taken, or 2000, 20 per share, or let's say 100, is it given? 100 is given. This 100. So 20 into 100, that much will be my loss. So 200 rupees will be my, 2000 rupees will be my loss, isn't it? So understand the concept of buying the put and selling the put. Okay. The worst can happen is that the price of the build company will decline to 0. Can happen. Kingfisher Airlines. You saw it. Kingfisher Airlines. Vijay Mallya. You saw it, down 0. If somebody had purchased this put and sold this put at that time, huge loss, isn't it? So if it goes to 0, what will happen if it goes to 0? Complete loss of mine. 50 rupees and then 0. 50 into 100. 5000 will be the loss in this case. See this. 5000. Complete loss. Right? So this is the basic logic of call and put options. Everyone must understand this call and put options concept very clearly. Okay? This is what was my main concern of discussion today. Because I wanted you to understand this call and put market. This table is the most important table for you in your BFM, in your derivative segment. Most important. Don't miss it. which is the most important risk management function in the treasury? So which is the most important risk management function? Firstly, risk management. So which is the most important risk managing part? Now there are various things. Let's see. Balance sheet management, market risk management, policy management, and ALM means asset liability management. So which one is most important among these? Is it balance sheet management or market risk or policy or asset liability? Now many of you will think, obviously topic we have the topic of ALM. So answer will be ALM, isn't it? Think over it, but it's not that simple. One thing I'll give you in writing, that this is not the answer. Asset liability management is not the most important function. You'll say, sir, if this mismatches, just now you told me that 5% only is allowed, otherwise RBI will fine you. Agreed. It's not that it's not important. It's not the most important among these four. Which among these four is the most important one, without which your bank will be in a trouble if you don't manage it properly? Which one among these? Yeah. Is it balance sheet management? Okay, let's see one by one. Balance sheet management. Balance sheet management means what? Managing the balance sheet means what? Matching your assets and liabilities. Roughly this and this will be related to each other. So if this is not the answer, this will also not be the answer. So market risk management and policy management. So now think. The most important over here, the answer is market risk management. The most important one, market risk. Why? Because in any bank, there are basically three risks. Main are the three risks: operations, credit, and this market, right? Ops, credit, and market. These are the three risks in any bank. Main. Others as well. Others are there. Reputational risk is there. Business risk is there. Or we call it strategic risk. Liquidity risk is there. All these. But the most important one over here is always market. Remaining everything you can control. Everything. But market risk, not possible. Because market risk is not in your hands. You can only manage it. Try to manage it as much as possible. Okay? Means what? I'll give you an example. Market risk. Tomorrow there is a third world war. So if there is a third world war, immediately the oil prices will go up. Immediately all the banks will be affected. So is it in your hands as a bank? No. Tomorrow if RBI increases the repo rate by, let's say, 2%, it's not possible 2%, but then also you don't know what the situation might come. Is it in your hands? No. Right? So that's why that is known as market risk. Okay, so market risk management is the most important function in any bank. Got it? Move on. Asset liability management refers to the management of net interest margin, NIM. See this, net interest margin, NIM. NIM means what? NII divided by your yielding assets. So NIM, to ensure that its level and riskiness are compatible with the risk return objectives of the bank. It means what? Your NIM is as per the requirement. What is the requirement? Risk reward. Sure, if your NIM is too high, that is obviously good. NIM is high means what? Sure. What is NIM? NIM, just now I give you NIM. equals to NII divided by assets, or you call it yielding assets. So NII upon assets, that is known as NIM. Okay. So if somebody's NIM is high, then it will be very good. It will be happy. The person will be the happiest person. Why? Because what is NII now? What is NII? NII means net interest income. Means what? Average interest on the loans minus average interest on the deposit. That is your NII. Okay? NII, I'll just write in short now. Loan interest minus deposit interest. Everything is average. Deposit interest. That is your NII. So anyone will feel if this NIM, okay, is high, everyone will be happy. But it means you are getting higher interest. It means you might be giving some riskier loans. That is also possible. So this is the meaning of risk return objectives. So your risk and return should always match. I don't want huge returns. For that, I'll have to give riskier loans. That is also not required, isn't it? So, what does NIM refer to? What does NIM refer to? Okay. So now let's look at it. I'll remove all this now. You have got this. Remove it. So what does NIM refer to? It refers to the difference between the interest paid and the interest received after adjusting the total amount of interest generating assets held by the bank. Okay. So it refers to the total interest paid and total interest received, means loan interest minus deposit interest. Okay. After adjusting the total amount of interest generating assets, means interest generating assets. Understand this word. Just now I gave you assets. Assets means what? Loans. But it includes those loans only which are standard loans. If some loan becomes NPA, then that is not included. Okay. Next. So, number one. Number two. It refers to the interest paid on deposits by the bank. Everyone read this. It refers to the calculation of the difference between the discount given and the discount received. So NIM means discount given minus discount received. Is it so? It refers to the calculation of difference between the commission given and commission received. Simple one, isn't it? First one, A, right? Just now I give you NII upon assets. Okay, NII means what? Loan interest minus deposit interest. The interest which I receive minus the interest which I give. That's the difference. Upon assets. Okay. So answer is A. Dash represents sources of funds and dash represents uses of funds in bank balance sheet. Which are the sources and which are the uses? Many of us will get confused over here. Kindly note there are two types of balance sheets nowadays. Okay. One is known as horizontal balance sheet, horizontal. And second is known as vertical balance sheet, vertical. Okay. One is horizontal, second is vertical. These are the two balance sheets. Generally, all the banks nowadays use this vertical form of balance sheet. Do you know what it is? Horizontal balance sheet means you have two parts. One is liabilities over here, liabilities, and second is assets, right? You have this. Then you have again two parts, current assets, fixed assets, right? Current liability, fixed liability. These are the four types of sections over here in horizontal balance sheet. Again, here you have two parts. Current assets are of two parts. One is liquid asset and second is normal current assets, other than liquid assets. And this fixed liability, that has also two parts. One is liability from outside agencies like bank or some bonds issued. And second is liabilities from inside, owner's liabilities, capital. So this is horizontal. But what is the question? The question is not on this. The question is on this. In vertical form of balance sheet, we have two parts. One is sources of funds and second is application of funds. Now see this. One thing I'll make it clear. Sources of funds means from where I get the funds. Where I get. So generally I'll tell you this part will be the sources of funds. This part. Here current liabilities and fixed liabilities. Here sources means what? Deposit. Depositor is a current liability. Or means what type of deposit it is. So what I mean by this? It is somebody is giving me money. So that is source of funds. So sources of funds means over here. So what are these deposits? Deposits. Okay. And second, or deposits, or you can call it liabilities. Liabilities. And second, application of funds means where do I use that funds? I'll use those funds in loans, assets, or loans. Okay, anything. So this is the answer here. Dash represents the sources of funds. What represents sources of funds? Deposits or liabilities. So liabilities will represent the sources of funds here. First blank is for liabilities. Second blank is for dash represents uses of funds, assets. Right? So liabilities represent sources of funds and asset represents uses of funds. Okay? So let's mark it clearly now. So the answer over here is liabilities B and assets. Okay? Clear? Next. You read this now. Which of the following is the role of Treasury in asset liability management? So which is the role of Treasury in ALM? It helps in identifying the market risk. It helps in hedging residual risk. It helps it monitors exchange and interest rate movements to identify the interest rate risk. So what does Treasury do? What is the role of Treasury in this? Treasury is always, look at this, Treasury will always focus on main job, market risk. We saw that question first. Market risk, that is the only main jobs here. There are two jobs of Treasury. One is market risk. Second is your forex. These are the two main jobs of your Treasury. Now somebody will argue that see, credit risk is also checked by Treasury. Agreed. Credit risk is also checked. Operations risk is also checked. Everything is checked. But the question is important, most important. Right? I go to my office, I sleep, I work, I go to movies. But which one is the most important, without which you cannot live? Food. Right? So that is the meaning. Which is the most, everything is required, but most important one. So the answer over here will be what? Is the role of Treasury in ALM. So what is the role of Treasury? It helps in identifying market risk. Yes. It helps in this hedging residual risk. Now what is this residual risk? What do you mean by this residual risk? And what do you mean by this word hedging? Hedging and residual. What do you mean by these two words? Let's go one by one. First, let me explain you hedging. Hedging means reducing. Remember, three words are very important. Hedging, leverage, and arbitrage. These three words will cover your entire BFM. Hedging, leverage, and arbitrage. Entire BFM depends on these three words only. Hedging means reducing, leveraging means expanding, moving ahead. taking more risk. And arbitrage means buying in one market, selling in another, in short span of time. Okay. So, hedging means reducing the risk. What do you mean by this? See here, simple example. Why do you buy the car insurance? Why do you buy the bike insurance? Why do you buy the life insurance? Tomorrow if something happens to the car, bike or even yourself, the risk of no money or a loss will be reduced. That is the meaning of hedging. Insurance is major hedging point or hedging tool. Okay. Others are also there, like derivatives. Okay, CDS, credit default swaps, total return swaps. All these are there. We'll come to it later. Okay. For that, join the paid batches. Very important ones. Okay. Here also I'll cover it when the topic comes. So hedging and residual risk. What is residual now? Residual means what remains after everything. I apply all the tools, I apply all the hedging material, I apply everything, but then also some risk remains. So that is known as residual. So it helps in hedging the residual risk. Whatever is hedging or whatever is remaining, Treasury tries to adjust that also. Obviously, that is the job. Every risk of yours should be adjusted. Kindly note. Very simple rule. So, correct. Now, do you have the answer 1 and 2 anywhere? No, only this. So, answer will be this only, simply. In exam, whenever you see such things, 1 and 2 as the answer, correct one. But you don't see 1 and 2, you see only here. So, obviously, third will be correct. Let's check, is third correct? It monitors the exchange. Exchange means forex. Here it means forex. So, its job is forex, isn't it? Forex management and interest rate movement to identify the interest rate risk. Interest rate movement. Interest rate movement means what? What type of interest rate? This relates to your repo rate, your CRR or any benchmark rate. See this, any benchmark. Now what do you mean? You'll ask me, sir, what do you mean by this? Any benchmark? Any benchmark means it can be related to forex. Here, if you are dealing in forex, then the benchmark is not CRR or repo. Nowadays it is ARR, alternative reference rate. Right? If you are dealing with this local currencies, repo, most important one, CRR for the banks. Right? So benchmark rates, any benchmark rate, that is basically this meaning of this interest rate. Okay? So interest rate movements to identify the interest rate risk. Identify. Okay? So the answer is 1, 2 and 3. Good? All of them. Clear everyone? Concept cleared? Yeah? Move on. Next one. Don't just focus on question and answers. Try to understand. Because in exam, it might happen that this question may not come or may come, anything. But the explanation, what is given, will be useful to you. Focus on the explanation. Okay? Next one. The steps involved in ALM process are. So what are the steps in ALM process? Steps. Okay? Let's read one by one. Reviewing the interest rate. Examining loan and investment, credit risk and contingency risk, and reviewing actual performance. Next, understanding the process of deposit, making proper payment, and identifying queries. Queries not, it's queries, it's not queries. Okay, queries. Queries is your mining. Okay. So identifying queries and processing services, delegation of loans, reviewing loans, making proper adjustments, etc. Okay, adjustment, making proper adjustments, etc. Okay. and all of the above. So which are the steps involved in the ALM? Asset liability. Is it reviewing the interest rate, examining the loan and investment? So yeah, reviewing the interest rate is a part of your ALM. Obviously, it is the part of your ALM. Because ALM means what? Asset and liability, loans and deposits. Okay. In Treasury, it is bonds purchased, assets, versus bonds issued, liabilities. So it can be anything. Simple rule is, wherever I am applying the funds, wherever what are the sources of funds. Simple logic. Okay. So A is the answer, obviously. What about B? Understanding the process of deposit, making proper payment, identifying queries and processing services. So process of deposit, making proper payment. Third, delegation of loans, reviewing loans. Okay, making proper adjustments. This is related to loans. Delegation of loans. Delegation of loans means various powers to various employees. At what level, what power should you give? To the BM, what will be the power? To the regional manager, what will be the power? So is this a part of Treasury? Treasury? This is not the part of Treasury. That's why I said all of these is not always correct. This is not the part of Treasury. This is the part of your management, board of directors, policy. Right? This is not the part of your Treasury loans. Okay? Similarly over here, process of deposit, making proper payment, identifying queries. This is a procedural issue, operations part. This is not the part of ALM. ALM is a part of always market risk. Kindly note, market risk. So the correct answer is A. Okay, this is your correct answer. Reviewing the interest rate, examining the loan and investment, credit risk, contingency risk, reviewing actual performance. This is the main role of ALM. You have to check the performance. Performance means what is the performance of your bonds portfolio? What is the performance of your loan portfolio? What is the performance of your deposit portfolio? That's what is done in Treasury. Okay? Next. You got it? Answer A. Not all of the above. Okay? Which of the following statements is correct? Correct. Regarding organizational controls of the bank. Organizational controls. Okay? So basically we are dealing with Treasury. Bank Treasury, you can write it. Okay? So bank Treasury. So what is the which of the following statements is correct? The front office deals with counterparty banks. Front office will deal with counterparty banks. Counterparty means opposite party, buyer and seller. If you are the seller, the other party will be the buyer. So front office deals with that. Back office is mainly responsible for confirmation, accounting and settlement of deals. Mid office maintains the overall risk profile of the Treasury and also monitors the liquidity and interest rate risks, which are close in line with the ALM guidelines. Which of them is correct? What does front office do? Front office is like the soldiers on the border. They are directly fighting. Front office is the same. They are fighting. They are dealing with the various banks, various customers, banks as well as non-banks, buying and selling, making the deals. So A is correct. Back office settlement. Take the transactions. See to it that every transaction is settled. Mainly responsible for confirmation, accounting and settlement of deals. Correct? That is also. Settlement of deals is an important part in Treasury. Kindly note. Don't underestimate the power of back office. Many of us feel that front office is very important. Dealing. Nothing like this. Each office is important. Front, mid and back. Each one has its separate role. Okay. So back office is also responsible for confirmation, accounting, and this settlement of deals. Mid office manages the risk profile, overall risk profile. So this is the main department, mid. This is the main department in banking, in treasury. Of course, all are important, but main one. Because this provides the input to the front and it provides the input to the back also, back office. Okay? So, mid office maintains overall risk profile and blah blah blah, remaining everything you can read. Answer is all of the above. That is the right answer. Okay? Next. One second. Yeah. Take this numerical. Consider the 6-month long forward contract of a non-income paying security. Here, 6-month long forward. This numerical I told you, we'll be solving a numerical. This is the one. This is a sure shot exam numerical in the exam, and very simple one. Very simple. Okay. So consider a 6-month forward contract of non-income paying security. Non-income paying. Okay. The risk-free interest rate is 6% per annum. It's a sure shot question in your exam. Kindly note, sure shot. It's there in your book also. 6% per annum. The stock price is 30 and the delivery price is 28. So stock price is 30 and delivery price is 28. Calculate the value of the forward contract. Now there is a formula. Don't think too much. It's very simple, one line answer, but there's a formula attached to it. If you don't know the formula, you'll just beat the bush. This, that, don't do anything. Simple formula I'll give you. Okay? Forward price equals to F equals to 30 into E raised to, okay, 0.06 into 0.05. So what do you mean by this? See this, value of the forward contract F equals to F minus K. So F minus K means what? Forward price, this F minus K. K means the fixed delivery price. K is a delivery price. F is the forward price which you have calculated. What you have calculated? This one. How did you get this answer? 30.90. See, E raised to 0.06 into 0.05. Now this calculation you will have to do it. If you do the calculation, it is 30 plus E raised to 0.06 into 0.05. Into 0.5 also, it's simply 0.5. So 30.90. So value of the forward contract is F minus K into E raised to minus RT. Okay. So F minus K, see this, E raised to minus RT. F is what? 30.90. This is what which you had got. Minus 28 into same equation again. E raised to minus RT means 0.06 into 0.5. It is 0.5 over here. So this is 0.06 into 0.5. Okay. So this same thing is repeated over here. Look at it. So if you solve this, multiply this and solve it, you will get it 28, approximately 2.8. Approximate. So this is the value of the forward price. Means value means what? This is a premium to be paid. Okay. This question comes in exam. Remember this. This question will be there. Okay. So don't miss this question. Very important one. Okay. It's very small, but it's very, at least you can remember the number also. If you can't remember the whole thing, kindly remember the answer. Means it's just a lighter part, but I would suggest you follow the whole process. Okay. So these were all the case studies and the objective questions for this session. Tomorrow again, I'll be taking another session of similar one. So hope so you have enjoyed it. So like this video, subscribe to this channel, click on the bell icon. Don't miss this. Now before going, let me show you the new batches. See, the new batches have just now started. Go to Adda 24/7. Now there are two types of batches. Look at this. Those who are planning for this 14th exam, you can join the fast revision batches. See this, CIB June 25. You can join the revision batches. See this, CIB June 2025. Click on this. Here you will get ebooks, mock test, and all the numericals are solved and the case studies are solved. Very important ones. You have the recorded videos also. If you have missed something, you can go through it. I'll share important PDF also. See here, you can definitely clear the paper in remaining 8 to 10 days. If you follow the PDF which I'll give you in the paid classes, as well as go through the recorded sessions. Whatever has been done, kindly go through it. Many important numericals are taken. Okay, so don't miss this. Also, those who are planning for November series, okay, for them there is a lot of time. So we have for November series, we are having new batches. Okay, I would always suggest you to join this increment Mahapack. In Mahapack, you are getting 15 plus batches per subject. Join this because you are having ample time. Almost 6-7 months are there. You can definitely go through this Mahapack. You get 15 plus batches plus physical books are also delivered. Physical books plus ebooks. So everything is there. We have started a new batch also, Warrior batch. You can join that batch also, Warrior. See, go to Adda 24/7, JAIIB CAIIB. Always go through the app. Kindly note. In the app, you are getting 1% extra. Okay. Go to December 25. Say this. Now here you will see all the official things given. Okay. So for December 27, you will have these batches. Okay. These are the books. Okay. So you can go for the batches also. Warrior batch. You can go for the Warrior batch. In Warrior batch, say this Warrior. This Warrior batch. Ebooks, mock tests, online live classes, same thing. But it's in detailed. But I would always suggest you to join the Increment Mahapack. Because there you get physical books also, 15 plus batches also, and right now, double validity is going on. Double validity. Okay, this is one of the best features for double validity. Here I'll show you what is double validity. Now if you look at this, see the CIB Increment Mahapack. See the CIB Mahapack, take this. So double validity means you buy for 6 months, you get it for 12 months. You buy for 8 months, you get it for 16 months. Plus 80% off is there. Means this, see, how do you get 80%? Click on buy now. Put the code Y432. Never forget this code Y432. Click on apply. See this. 79% discount plus 1% extra through the app. That's why I'm saying download the app first and then purchase. Okay. So let's see you tomorrow and see you in the classes. Join the revision batch ASAP because only 8 days are remaining now. 8-10, right?